June 13, 2026. Fintech and Markets Briefing. 5 major developments in Treasury, risk, payments, RegTech, and trading infrastructure. Keycap 1 Corporate Treasury and Cash Flow Management. CFOs embrace stablecoins for smoother global cash flows. Corporate finance chiefs and treasury teams at major companies are venturing into digital assets as they seek new ways to optimize liquidity amid surging e-commerce and cross-border trade. This week, industry surveys and executive reports suggest that stablecoins, cryptocurrencies pegged to traditional currencies, are rapidly entering enterprise treasury operations as mainstream tools for cash flow management. These digital dollar tokens, once seen as fringe experiments, are being piloted to reduce payment settlement friction, accelerate cross-border collections, and shorten working capital cycles. Motivated by the promise of near-instant, low-cost international transfers, some CFOs at multinational firms have begun using stablecoins for supplier payments and global e-commerce revenues. In a striking sign of their rise, stablecoin networks handled nearly $11 trillion in transactions last year, approaching the scale of Visa's global card payments, underscoring how quickly these digital dollars are gaining ground in corporate finance. Such eye-opening numbers, almost on par with mighty card networks, highlight how digital assets are opening a new frontier in treasury practices fueled by online commerce. What was once a cautious curiosity among corporations has transformed into a wave of high-profile endorsements of digital currency. In recent months, several global companies have publicly dipped their toes into stablecoins. Sony's financial services arm, for instance, is building a US-regulated, dollar-pegged token for its digital media customers. And Intuit has partnered with a major stablecoin firm to integrate USD Coin, USDC, into its small business platform. Significantly, e-commerce giants Amazon and Walmart are rumored to be exploring their own branded stablecoins, aiming to streamline customer payments and loyalty programs across their vast online marketplaces. These corporate experiments in digital money are helping validate the economic case for stablecoins, from reducing costs on cross-border e-commerce transactions to compressing settlement times for international suppliers. As treasurers gain confidence in the security and utility of these tokens, stablecoins are moving from peripheral pilot projects to tangible financial tools, signaling that the digital asset era has arrived in corporate finance. On the legal and regulatory front, fresh clarity on digital assets has emboldened CFOs to act. In the United States, a landmark stablecoin law, nicknamed the Genius Act, took effect in January, establishing the first federal rules to fully back payment stablecoins with dollar reserves and limit issuers to regulated institutions. Likewise, the European Union's far-reaching markets in crypto assets, MiCA, framework is now rolling out across Europe, imposing licensing and governance standards for crypto tokens, with authorities from Washington to Brussels signaling support for well-regulated digital currencies. Companies are treading into crypto finance with greater confidence. The hope is that under strong oversight and modern compliance tools, stablecoins can deliver their advantages in cross-border e-commerce without compromising financial stability or customer protection. From boardrooms to blockchain labs, a new consensus is emerging. The digital dollar revolution in corporate treasury is no longer a far-off moonshot, but an imminent reality. Keycap 2 Enterprise Risk Management, reinventing risk strategies for an AI-driven, always-on world. In boardrooms and risk committees across the globe, the conversation in mid-2026 is dominated by how to manage an unprecedented new landscape of risks spanning cybersecurity, artificial intelligence, and geopolitical volatility. Cyber threats remain the #1 concern for companies worldwide, according to recent global surveys, reflecting relentless waves of data breaches and ransomware attacks on supply chains in an increasingly digitized business environment. The same digital innovations propelling growth in e-commerce and finance have expanded the attack surface for organizations, making technology risk management an existential priority. With operations migrating to the cloud and customers expecting services 24/7, the stakes of a cyber incident or system failure have never been higher. A reality not lost on risk leaders tasked with safeguarding value even as commerce becomes borderless and potentially extends into space in the future. The rise of powerful generative AI tools presents a double-edged sword, on one hand offering faster analytics and anomaly detection for risk teams, yet also introducing novel threats such as AI-generated fraud and unpredictable algorithmic behavior that strain traditional controls. Companies are responding by digitally transforming their risk management practices to stay ahead of these threats. Forward-looking firms are investing in predictive risk analytics and AI-enhanced early warning systems capable of sifting through vast data streams, from network logs to financial transactions, to flag anomalies and vulnerabilities in real time. Risk management has become a proactive, cross-functional discipline, with cybersecurity, finance, compliance, and operations teams collaborating to stress-test resilience against worst-case scenarios. Many multinational enterprises now conduct continuous red team cyber drills and wargame extreme events, from large-scale e-commerce data breaches to sudden regulatory shocks, to strengthen their crisis response muscle. Global risk monitors also point to macroeconomic and geopolitical hazards, such as inflation surges, supply chain disruptions, and regional conflicts, that further complicate strategic planning. Effective enterprise risk strategies increasingly call for a blend of cutting-edge defenses and resilient business continuity planning, integrating advanced analytics, scenario simulations, and agile contingency frameworks to navigate a world of interconnected perils. In response, global regulators are raising the bar on risk oversight, especially at the intersection of technology and commerce. In Europe, the Digital Operational Resilience Act, DORA, now requires banks, payment providers, and other financial firms to meet strict cybersecurity and third-party risk management standards, ensuring that critical technology systems supporting digital commerce are resilient. The United Kingdom is coordinating closely with EU authorities on oversight of major cloud and IT providers, aligning their approaches with DORA and recognizing that financial and e-commerce services rely heavily on a few key tech platforms. In the United States, agencies like the Securities and Exchange Commission have moved to mandate that public companies swiftly disclose significant cyber incidents and elevate climate and operational risks in their financial reports. The message from policymakers is clear. As business becomes ever more digital and borderless, companies must invest in advanced controls, transparency, and agility to keep pace with the fast-evolving risk landscape and maintain stakeholder trust. KeyCap 3B2B Payments and Infrastructure Fintech, cross-border payments revolution as businesses demand speed. A quiet revolution in business-to-business commerce is making global B2B payments faster, cheaper, and more interconnected than ever, a promising development for digital trade and e-commerce supply chains. In the United States, real-time payment networks like the Federal Reserve's new FedNow system and the private RTP rail have graduated from pilot programs to core infrastructure, with most major banks now enabling instant transfers around the clock. Adoption is spreading internationally as well. By 2026, over 40% of merchants worldwide report accepting real-time payments, and more firms are using instant payout capabilities for supplier invoices and payroll. Settling transactions in seconds instead of days has proved transformative for companies with tight working capital cycles, freeing up cash that used to be trapped in transit. As a result, instant payments are quickly becoming the default expectation for many B2B transactions, not the exception. As the race to digitize B2B payments heats up, fintech innovators and financial giants alike are unveiling new solutions for cross-border business transactions. One headline example is TransFi, a Dubai-based startup that launched a service called BizPay to let small businesses in Southeast Asia send and receive funds across borders via simple messages on chat apps. BizPay went live this spring in markets like Indonesia, Malaysia, the Philippines, and Vietnam as part of a broader push by ASEAN central banks, working with the Bank for International Settlements, to connect real-time payment networks across the region. The platform doesn't even require a separate app. Companies can invoice international clients and settle payments without leaving the chat thread, using stablecoins or local currencies seamlessly. By letting businesses tap both cryptocurrency rails and local banking systems in one flow, BizPay and similar services help cut fees and delays that have long plagued international e-commerce transactions. Established giants such as Visa and MasterCard are also expanding into B2B digital payments, piloting blockchain-based cross-border settlement to complement their card networks. The convergence of fintech startups and large banks through partnerships and acquisitions signals a bullish outlook for the future of real-time global commerce. On the regulatory front, policymakers are updating rules to accelerate secure digital payments and protect online commerce. One key development is Europe's Payment Services Directive 3, PSD3, a sweeping reform agreed in late 2025 that aims to strengthen fraud prevention, promote open banking competition, and increase transparency in online payments by 2026. Regulators across North America and Asia are likewise encouraging instant payment adoption while tightening safeguards, recognizing that the future of B2B commerce hinges on payments that are both lightning fast and safe. By modernizing outdated rules, authorities hope to clear away remaining frictions and foster a more integrated global payments ecosystem, one where businesses of all sizes can transact across borders as effortlessly as sending a text message. KeyCap for RegTech, regulatory technology, compliance goes real-time under mounting digital rules. Facing a surge of new laws and enforcement pressures, the financial industry is rapidly embracing regulatory technology, RegTech, to make compliance as dynamic and digital as the business itself. This shift from periodic, manual checks to automated, real-time oversight has been propelled by looming regulatory deadlines and the high cost of non-compliance. For example, Europe's recent crypto asset regulation, MiCA, has set a mid-2026 deadline for service providers to secure licenses or cease operations, and the U.S. Congress's new Stablecoin Act is now in force. Developments that put compliance teams under pressure to move faster and smarter. In response, banks, fintech firms, and e-commerce platforms are deploying advanced software to continuously monitor transactions, flag suspicious activity, and update controls the moment rules change. The payoff is not only fewer regulatory headaches and fines, but also improved efficiency. AI-driven compliance tools can vet clients and transactions in seconds, reducing false alarms by up to 40% and saving big banks an estimated $100+ million annually in manual screening costs. Now that RegTech has shifted from a novelty to a mission-critical investment, financial institutions are racing to automate everything from customer due diligence to risk reporting. Machine learning algorithms and natural language processing systems can scan through massive volumes of regulatory text, automatically mapping new rules to internal controls and flagging any gaps. Know Your Customer, KYC, and anti-money laundering checks that once took days now often finish in real time, enabling even large online marketplaces to verify new sellers and filter out fraudsters almost instantly. Continuous monitoring and on-the-fly analysis are replacing the old model of periodic audits, so compliance officers can detect problems and intervene immediately. For companies, this blend of automation and human oversight means faster onboarding of good customers, fewer manual reviews of false positive alerts, and reduced overall risk of compliance violations. It not only slashes costs, but also strengthens relationships with regulators and customers by showing a proactive commitment to security and transparency. Regulators themselves are encouraging this technology-forward approach to compliance, recognizing that innovation must be coupled with rigorous oversight. In financial hubs around the world, supervisors are adopting advanced analytics to police the markets, from AI algorithm scanning for trading manipulation to blockchain forensics tracing crypto flows, and urging industry to do the same. Policymakers emphasize that if fintech and e-commerce companies want to push boundaries with AI and digital assets, they must employ equally cutting-edge RegTech to maintain transparency, security, and consumer protection. The ultimate promise is a financial system where compliance is seamlessly embedded into operations. By leveraging real-time data and intelligent automation, RegTech is transforming compliance from a cost center into strategic infrastructure, a change that helps institutions scale responsibly in 2026 and beyond. As commerce expands to new realms, potentially even off-planet in the coming decades, such dynamic, always-on compliance capabilities will be essential to safeguard trust on every frontier. KeyCap 5 Institutional Trading and Market Infrastructure. Exchanges push boundaries with 24/7 trading and tokenized assets. Major stock exchanges are pushing to break free from the traditional 9 to 5 trading cycle to accommodate a global, always online investor base. Nasdaq is moving forward with plans to extend U.S. stock trading to nearly 24 hours a day, 5 days a week, with only a short daily maintenance pause, a dramatic shift that could begin as early as late 2026 if regulators approve. The aim is to align American markets with worldwide news cycles and allow continuous stock transactions across time zones, but the prospect has sparked debate on Wall Street. Critics warn that thinner pre-dawn liquidity could amplify volatility and force companies into perpetual on-call mode with no downtime for news releases. Some skeptics fear it could further gamify equities trading by turning markets into a 24/7 casino, while others argue that round-the-clock access is a natural evolution, especially given that crypto markets already operate non-stop. Major retail trading apps and cryptocurrency exchanges are already offering nearly 24/7 trading on select assets, and the New York Stock Exchange has likewise received an initial regulatory green light to expand trading to 22 hours on weekdays. Whether met with enthusiasm or caution, the drive toward always-open stock markets reflects the digital era's demand for instant access, an adaptation that may prove essential as commerce and even human enterprise beyond Earth increasingly operates without pause. This push for continuous trading is underpinned by breakthroughs in market infrastructure technology that enable faster, more automated trade settlement. Following the U.S. market's successful transition to a one-day T+1 standard settlement cycle in 2024, some industry voices are now exploring the possibility of same-day T+0 settlement using distributed ledgers and smart contracts. Real-world asset tokenization is also accelerating on a grand scale. Government bonds, money market funds, and other traditional instruments are increasingly being issued and traded as digital tokens on regulated platforms, delivering near-instant settlement, programmable transactions, and 24/7 liquidity. In Europe, a new distributed ledger pilot regime has allowed a consortium of banks and exchanges to execute bond trades and clear them in minutes on a shared blockchain, foreshadowing how future markets might operate with fewer intermediaries. Even central banks are examining wholesale digital currencies and bank-issued deposit tokens to facilitate large-scale interbank settlements at any hour. Bit by bit, the world's financial nervous system is evolving to support continuous, borderless market activity, exactly the kind of robust infrastructure that might one day be needed to connect markets on Earth with those of a space-faring economy. Market regulators are working to ensure these innovations don't outpace investor protections. In the U.S., the SEC and the Financial Industry Regulatory Authority, FINRA, have been drafting new rules for extended hours trading. From requiring stringent overnight risk disclosures to updating best execution obligations so investors get fair pricing at any hour. Across jurisdictions, officials are similarly debating how to supervise tokenized asset markets and cross-border digital settlements under evolving frameworks. Policymakers stress that financial innovation must be paired with effective oversight to preserve market stability and trust. By proactively addressing challenges, from cybersecurity in always-on systems to transparency in algorithmic trading, regulators aim to channel modernization in a safe direction. The hope is that markets can reap the benefits of these technological leaps and greater access without sacrificing the safeguards that protect investors. If humanity's economic ambitions ever extend beyond our planet, robust, around-the-clock market oversight will be even more indispensable. Disclaimer: the content provided in this report and video is for informational purposes only and does not constitute legal, medical, financial, or official advice. The news stories and analysis presented are anecdotal and intended for general information. They should not be construed as professional counsel or guidance. Always do your own research and consult qualified experts before making any decisions. Do not treat the following stories as advice. Video description. In this timely deep dive report, we explore 5 major developments shaping the future of finance and technology as of June 13, 2026. Discover how corporate CFOs are embracing stablecoins to streamline cash management and cross-border e-commerce, how enterprise risk managers are using AI and advanced analytics to tackle cyber threats in an always-on economy, and how innovations in B2B Fintech are revolutionizing global business payments. We also cover the rise of RegTech, cutting-edge compliance tools deployed as regulators tighten digital rules, and the bold move by stock exchanges toward 24/7 trading and blockchain infrastructure. Join us for a futurist yet practical look at how financial systems are evolving to serve a connected, high-speed world with positive, human-centric breakthroughs that could shape markets on Earth and beyond. Tags: Fintech, Finance, Stock Market, Corporate Treasury, Enterprise Risk Management, B2B Payments, Fintech News, RegTech, Market Infrastructure, Stablecoins, Real-Time Payments, AI and Finance, Cybersecurity, Digital Assets, Blockchain, E-commerce, Financial Regulation, Future of Finance, Space Economy, Futurism. Base thumbnail concept: a vivid, futuristic portrayal of global finance combining Earth and space elements. The base thumbnail shows a digital globe against a starry backdrop, overlaid with a network of currency symbols and stock charts that arc around the planet. A subtle hint of a rocket or satellite near the Earth's horizon suggests the expanding frontier of commerce. Bold, tech-inspired title text, Finance and Tech Frontiers, spans the image, conveying a cutting-edge, high-tech aesthetic. Thumbnail Variation A, a thumbnail highlighting the stablecoin and treasury theme. The image features a large, gleaming digital coin, representing a USD-pegged stablecoin, floating over a modern corporate city skyline at dusk. A subtle overlay of financial graphs or banknotes merging into binary code reinforces the blend of traditional finance with digital currency. The tagline text could read "Digital Cash for Global Business" to create intrigue. Thumbnail Variation B, a thumbnail emphasizing cyber risk and security.